and their surprising call on the U.S. economy. Before we get into all of that, we talk about housing. We talk about the Silicon Valley luxury market. Let's not forget that today is Memorial Day. Today is a day we should all have remembrance and thank those individuals who served and gave all. Memorial Day is an important day. Freedom is not free, and there are folks that paid the ultimate price. So do yourself a favor, step back, hit the pause button, just thank those who served and gave all. If you happen to be in CrossFit, which is something I have done for years, don't forget today is the day that many of us will attempt to do Murph. Murph is a CrossFit workout that starts with a mile run, then it moves into 100 pull-ups, 200 push-ups, 300 air squats, followed by another mile run. If you're feeling adventuresome, the workout actually calls to wear a 20-pound weight vest. So that is something that I will be attempting to do this afternoon, something that I look forward to doing each and every Memorial Day. But let's get into it because you are here for the daily financial news. Let's talk about the Citigroup's chief economist. They are calling for the U.S. economy to be heading into a deep recession, a hard landing. They expect deep rate cuts as the only solution. Folks, Citigroup is pointing at a weakening labor market setting up this hard landing. They're actually calling for four rate cuts this year. Again, think about that. We are in late May. They are calling for 4 rate cuts. That's, I think, what do we think? We have June, July, September, November, December. So basically, they're calling for 4 rate cuts starting in July, which is interesting. Of course, may not be quarter points. Maybe they come out with a half and then two quarters after that. But yeah, Citigroup is not feeling the U.S. economy. They are calling the job market weakening and many, many problems ahead. It's pretty interesting because you did hear Goldman Sachs recently push back their first rate cut decision to September. So we are starting to see different folks have different thoughts on the U.S. economy, soft landing, hard landing. I particularly still feel the rolling recession is the most likely, where different parts of the economy are hit with depression-level collapses, i.e. housing and mortgage. They eventually turn around and build out. Look at mortgage. Refi demand is up. Refi demand is up something like 17 or 18%. That, of course, is because of very small numbers. But it just goes to show you that a rolling recession takes time to play out. And it's not surprising that most economists aren't calling for it because it's not really something we've studied. We have the one in, I think it was the late 80s that many people point at is a rolling recession. But it's not something a chief economist is going to point at because it's so unique and out there. So again, yeah, Citigroup not feeling the U.S. economy. I want to give a special shout out to a guest we had on the channel all the way from Bali. Yes, folks, shout out Robert Sleeves. He did a show yesterday from Bali at 11:30 at night where he was talking about how he has a portfolio of mobile homes in Fayetteville, North Carolina, if I remember correctly. He is a military man. He served for 16 years. Fayetteville is apparently the largest base in the U.S., and he's found a unique solution. If you haven't seen that yet, I got to tell you, living in paradise, Bali, and investing in real estate, not a bad deal. Set up your cash flow. He sacrificed, worked hard for 5 years to set up the income, and then he still runs his business from Bali. I don't know about you folks, but there was so much value in that discussion that is just tried and true, one rental at a time. Live below your means, do the work, grind, get through the 5 years, and then, hey, you have the opportunity to make choices, such as moving to Bali, buying the big house. It is pretty awesome. So again, shout out Robert Sleeves. Also, don't forget today, you have the opportunity in about 30 minutes, if you are in my school community, to participate in a conversation with Omar El Takari and I, where we talk about the need for baby boomers and Gen X to start creating content around their passion. Folks, I don't know if you started to see this on YouTube, but trust me, it is coming. We are starting to see AI create lots of weak content. Lots of people are creating summaries. Lots of people are doing this and that with AI, and that will not stop. Why is that a good thing for guys like you and I? Well, I think you're going to very quickly see live, unedited content take off. Folks, that is really good news for me because I don't edit videos. It's just raw. If I misspeak or the dogs bark or whatever it is, it's there. I think there is going to be an explosion in the need for raw, unedited content. It will be seen as unique. I think you need to have this conversation. You need to be a part of the school community. You need to ask Omar questions. I know lots of you are creating content in channels around your passion. I thank you. It's the right thing to do. It will take time, but it is possible to create impact. Remember, folks, if you're following what we talk about here, you're chasing impact, not money. Let the 20-year-olds chase money in creating content. They're going to create something that is not scalable. You and I create something around our passion that fills us, that is fun. Money will come. Let's talk about something that starts on the 29th. The 29th, I think that's tomorrow, might be Wednesday. The U.S. Treasury is going to start to buy back $2 billion per operation, aka once a week, to improve liquidity and suppress rates. This is going to be interesting. Is this QE? Is this QE-like? Is it QE spin? Again, QE is typically related to the Fed. This is the Treasury. So I think I would definitely call it QE-like or QE Treasury or whatever you want to call it. But yes, they are coming in with $2 billion once a week to quote unquote improve liquidity and suppress yields. Folks, if you remember my conversation with the uneducated economist, the uneducated economist pointed at this exact thing and said it was a credible threat. This could be the credible threat that actually attracts others to start buying the treasuries and see rates fall. So again, it will be very interesting to see what happens over the next 3 to 4 weeks. I will certainly be watching this and reaching out to the uneducated economist should something get wacky. Let's talk about Jeffrey Roach, chief economist at LPL Financial. Jeffrey and his team at LPL have done some research around renters and homeowners. Renters and homeowners. So what do we got? Well, probably not shocking to anybody who watches this channel, but renters and homeowners are feeling the U.S. economy in very different ways. Why is that? Well, rents have gone up 20%. If you look at the average across the United States, that is up $370. While owners, i.e. people who own the properties, they have seen their mortgage payments their mortgage payment is at near a historical low for share of disposable income. Not to mention your mortgage payment, other than a little bit of insurance and taxes, is fixed. Your housing cost is fixed in an inflationary environment where wages now are finally going up more than inflation. You have what's called predictable cost. Folks, the game of building wealth is disposable income. I can't reiterate that enough. Disposable income. Today, the folks that are seeing disposable income grow are homeowners, not renters. Every time the renters get a bump, they seem to lose it to some inflation like rent or gas or something. Folks, the path to getting wealth has never changed. You need to own assets, preferably assets that cash flow, and you need to own them for a decade. The fact that this research from Jeffrey Roach, LPL Financial chief economist, is out there is, in my opinion, a sad state. Getting wealthy is simple. We talk about it all the time. Create more disposable income, become an elite investor at something, and do it for a decade. It's just that simple. It's just that simple. Folks, if you want to see a wacky housing market, I invite you to look at the Silicon Valley. Folks, the Silicon Valley market is nuts. Just nuts. How nuts, you ask? Well, homes priced over $5 million. Now, let's keep in mind, we have our median home price is $1.8 million, which is absurd. $1.8 million for a house around here, absurd. But we're not even talking median. We're talking $5 million. $5 million homes. They have spiked in April. We have seen 80% of the listings that go into contract over $5 million go for over asking. You ask, how can that be? NVIDIA. NVIDIA, folks, if you're not paying attention, has added $1 trillion in market cap. And if you happen to be an employee of NVIDIA and you've been getting stock for a while and not sold, you are ridiculously rich and you can write a big check. Yes, folks, $5 million properties in the Silicon Valley are going for over asking. Wild. Just wild. Looks like the European Union has had enough. The European Central Bank has had enough. The European Central Bank looks like they will cut rates. Yep, the ECB will be cutting rates next week, according to two Fed presidents, or actually they call them central bank presidents, Olli Rehn and Philip Lane. Inflation is falling in a sustained way. It is time we cut. Yes, folks, you're going to start to see the divergence of the euro and the dollar. What does that mean? Well, assuming they do cut means the dollar gets stronger, right? Assuming the Fed does not cut, which I think we can all agree they're not cutting in June. But yes, you're going to start to see the dollar potentially strengthen. Could this be why the Treasury is starting to get ahead of the game and create more liquidity, create some pressure on rates? Maybe. I don't know if you've seen this, but it looks like the SEC has opened the door to the Ethereum ETF. Obviously, there was the Bitcoin ETF, which I think's been out for, call it 4 or 5 months. Looks like the Ethereum ETF is going to be following quickly behind it. What might happen there? Don't know. And then finally, let's talk about big builders. This was actually something I highlighted with Lance Lambert right after Silicon Valley Bank. Right after Silicon Valley Bank collapsed, I have a session with Lance Lambert where I talk about the following happening. You are going to see big builders dominate as smaller builders pull back. When commercial banks tighten, small builders suffer. Big builders win. What do I mean? Well, in 2005, big builders, national builders, publicly traded builders accounted for 25% of production. 25. 1 in 4. In 2023, because of what happened with commercial banks and the like, big builders, public builders, folks with stock, they could borrow, they could sell, now account for 51%. That is a significant jump from 25 to 51%. I want to give a shout out to Allie Wolf. Allie Wolf follows the builders. This is her data that I am sharing with you. Follow Allie Wolf on Twitter or X. She is a great follow. And then the last thing, I want to give a shout out to Bill McBride. Again, a follow on X. He produced some housing inventory data today. Usually I get this from Logan Matashami or others, Mike Simonson, but I think they're taking Memorial Day off. So Bill McBride, housing inventory for the week, up 2.9%, up 37% year on year. Folks, higher rates matter. More inventory, good thing. Days on market higher, good thing. Except if you're in the Silicon Valley looking for a $5 million home, but I digress. Again, why do I call more inventory a good thing? Because if you're watching this channel, it's very likely you're an investor looking to buy your first property. We want a slower housing market. We don't want to compete with everybody with no inventory. You and I want to find that motivated seller. Trust me when I say motivated sellers are easiest to find in a slow housing market. Track days on market for your buy box. Get ready to write disrespectful offers. The time is coming. Folks, if you don't know already, I do have an amazing course called How to Get Started One Rental at a Time. It's ridiculously priced at $3.99. Gets you access to a private Facebook group. Gives you the ability to create a buy box, daily discipline, meet new people. Has lots and lots of bonus stuff. I'm also going to give away the Las Vegas event recording, which is a $200 value. If you want to get started, you want to get your buy box, you want to start doing the daily discipline, you can buy the course below. There's a link below. If you don't, no big deal. But again, let's get ready for the school community. If you're in the school community, you're going to get a chance to interact with Omar and I, talk about how to build a brand, how to follow your passion, how do you find your bliss, creating something you are passionate about. Again, folks, if you are a baby boomer or Gen X, the time is now. While you're working, build this little thing on the side once a week. You can do it, and I think you will find value in it. If you're not part of the school community, it's time to join. We are almost at 50 students. Once we get to 100, we are going to start to keep content only available on school. Some of the interviews that you like and follow will only be available on school. So again, check it out. We did do Dan Bird with school yesterday. His second video will come out at 9 today. Take care. Thank you. Later.